The first 6 months of 2025 have been anything but boring. From tariff surprises to geopolitical conflicts and shifting economic data, the first half of the year has tested investors' nerves and strategies alike. Hi, I'm Iván Mendoza, Managing Principal at Mendoza Private Wealth. In this video, I'll review the key highlights of the first half of the year so you can understand what's driving the market and what it means for your financial plan. So let's start by taking a closer look at the dynamics that led to a bounce back in equities. As you can see in this first chart, from the peak in mid-February to the bottom in early April, concerns around global tariffs caused an almost 20% correction in the S&P 500 index. Once the 90-day pause on tariffs was announced, investors felt reassured that there might be opportunity for further negotiations or at least more time to digest the changes. The market was further reassured when just a few weeks later, the US and UK announced a tentative trade deal. Talks of a tentative US and China trade deal helped as well. All of this has led to an S&P 500 year-to-date performance through June of 6.2%. Now, surprisingly, in spite of geopolitical concerns around global trade, developed non-US markets like Europe, Asia, the Far East put up an even more impressive 19% return, with emerging markets not too far behind at 15%. In fixed income, municipal bonds were basically flat for the year, which was a bit disappointing, but perhaps even more so when compared to US taxable bonds, which were up 3.8%. But all in all, this is a solid first start to the year, and although certainly there was serious volatility along the way. Going forward, inflation still remains a focal point as the Federal Reserve weighs its next move later this month. Fortunately, as you can see here on the far left side, both CPI, Consumer Price Index, as well as PCE, Personal Consumer Expenditures, have been steadily trending down toward the Fed's 2% inflation goal. In addition to inflation, the Fed is likely keeping a very close eye on the labor market. As you can see here on the far left, the labor market has essentially found its way back to a balanced equilibrium point similar to pre-pandemic levels. Contributing to this balanced state is a relatively flat layoff rate here in purple, combined with a steadily declining hiring rate in yellow. Simply put, employers have been hiring at a slower pace, but they have not shown any significant increase in massive layoffs. While a recent uptick in continuous jobless claims may be an early sign of weakness, the U.S. unemployment rate is still hovering around normal levels of around 4.1, 4.2%, although this is something that we'll be watching very carefully. If the labor market does weaken, it may have something to do with a recent decline in consumer spending. As you can see here in the middle chart, where it shows a clear downshift in consumer spending as measured by personal consumption expenditures. This puts even more pressure on the Fed to consider lowering interest rates. Investors are still expecting rate cuts this year and in 2026. The friction is in when the rate cuts will arrive. In summary, 2025 is expected to be a low growth year at 0.5% real GDP, while 2026 is expected to be a bit better. Inflation expectations remain a bit elevated at 3.8% this year, but hopefully inflation will continue to cool down into the 2% range by year-end 2026. With this rebound, the market is essentially giving investors a bit of a gift, a second chance this year, if you will, to determine if a reduction in risk would be appropriate. Now, in general, we recommend staying fully invested and diversified across asset classes, but we do think this is a great time to revisit the overall level of equity exposure and particularly reassess any concentrated positions. If all of this leaves you questioning whether your current strategy still makes sense, well, that's where having a trusted advisor can really make a difference. Navigating today's market dynamics isn't easy, but with the right strategy, you can stay on course toward your financial goals. If recent market volatility has you wondering whether your portfolio is well positioned, I'm here to help. Reach out for a complimentary review of your investments. Make sure that they're aligned with your risk tolerance and long-term objectives. Contact me at 305-501-5133 to get started. Thanks for watching.